I mean, if you've been watching the markets, you've definitely seen the headlines screaming about this massive, unstoppable spike in bond yields. It sounds super complicated, right? And honestly, kind of alarming. But hey, that's exactly why we're here. We're going to decode exactly what this magic 5% threshold actually means, why it feels like it's breaking the market, and most importantly, how it directly impacts your wallet.
So here's our roadmap for today. First, we'll look at the 5% threshold. Then, how bond yields actually work. Third, why yields are spiking. Fourth, 4 economic warning signs. And finally, how this all affects you. Let's get into it.
Starting off with Section 1, the 5% threshold.
Okay, so for the very first time since the great financial crisis of 2007, which, wow, is just wild to think about, bond yields have crossed a really specific, almost magical line, 5%. And look, this isn't just some random number we're throwing around. It's actually a massive structural pivot point for the entire global economy. Because what's so fascinating about hitting 5% is what it really represents. Think about it. For the last 15 years, our whole economic system was essentially built on cheap money. Homes got crazy expensive because borrowing was so easy. Stocks went through the roof because investors literally had nowhere else to park their cash to get a decent return. But right now, that entire system is reversing. Major institutions and everyday investors are suddenly pausing and asking a pretty dangerous question. Why take on all the crazy risks of the stock market or real estate when you can just grab a guaranteed 5% return for doing absolutely nothing?
Which brings us to Section 2, how bond yields actually work.
Let's take a quick second to nail down the mechanics here. Whenever the US needs money, they issue treasury bonds. Just think of it as a super simple IOU from literally the safest borrower on the planet. The government basically says, hey, lend us your money today, we'll pay you a fixed, consistent interest rate along the way, and at the end of the term, you get your original cash back. And because the US government defaulting is incredibly unlikely, this is treated as a risk-free rate of return. Pension funds, big banks, regular investors, they all buy these bonds as the ultimate safe haven. And this perfectly illustrates the part that almost everybody misses, the inverse math behind all those scary headlines. It's actually amazing how simple it is when you break it down. Let's pretend a bond pays a fixed $5 in profit, right? If everyone wants that bond because it's safe, demand is high, so investors bid the price up to, say, $125. That fixed $5 profit now only gives you a 4% yield. But if demand totally tanks, investors might only pay $80 for that exact same bond. Suddenly, that same $5 profit works out to a much higher 6.25% yield. Bottom line, as the price goes down, the yield goes up. So the absolute key takeaway here is this. Bond prices and bond yields always move in opposite directions. It's an inverse relationship. Anytime you see a headline practically screaming that yields are spiking, all it actually means is that people are aggressively selling off government debt. Prices are dropping because investors are demanding a much higher percentage return just to be willing to lend their money to the government.
Moving on to Section 3, why are yields spiking?
Well, there are 3 massive forces slamming into the market all at once right now. Step 1 is the stubborn resurgence of inflation. We just saw data showing CPI jumping to 3.8% year over year, with wholesale inflation hitting its fastest pace since 2022. Step 2 is oil. Thanks to ongoing conflicts in the Middle East, oil prices spiked past $100 a barrel. And since oil literally drives shipping, manufacturing, and food production, it pushes inflation even higher. And step 3, the US government is absolutely flooding the market with new debt.
To really put that last point into perspective, the United States is currently running annual deficits of roughly $2 trillion. That's trillion with a T. We are spending so much more than we make that the Treasury is forced to constantly print literal mountains of new IOUs just to keep the lights on. It's a colossal oversupply of debt. And making this oversupply even worse is a sudden, glaring lack of buyers. Take Japan, for example. They're the largest foreign holder of U.S. Treasuries, sitting on about $1.2 trillion worth. But right now they have way less incentive to buy U.S. debt because their own domestic yields back home have shot up to historic highs. So picture this. You've got a massive flood of new bonds hitting the market, way fewer foreign investors willing to scoop them up, and so the U.S. simply has to offer higher and higher yields to attract whoever's left.
Let's look at the fallout in Section 4, 4 economic warning signs.
This whole situation triggers a really severe 4-part shockwave across the entire economy. First up, the government debt spiral. The U.S. already pays over $1 trillion a year, just in interest. Every single 1% increase in yields tacks on tens of billions more to that tab, forcing, you guessed it, even more borrowing.
Second, the stock market comes under massive pressure. Third, the housing market basically freezes solid. And fourth, corporate America hits the brakes on hiring and expansion because borrowing money suddenly costs way too much.
Let's zoom in on something that hits incredibly close to home for a lot of us, the housing market. If you bought a house a few years ago, you probably locked in a mortgage around 3%. Today, we're looking at rates hovering between 6.5% and 7%. Think about that. If you've got a sweet 3% rate, there's virtually no way you're giving that up just to move across town and pay double the interest. It makes zero financial sense. And because nobody wants to sell, housing inventory totally locks up, keeping prices stubbornly, frustratingly high for anyone trying to buy.
Meanwhile, over in the stock market, the pressure is just as intense. High-growth tech companies get absolutely hammered because their future valuations suddenly look pretty grim compared to what you can get today safely. I mean, ask yourself, why endure the brutal, stomach-churning volatility of the stock market when the U.S. government is offering you a guaranteed, risk-free 5% return? As that yield creeps up, we see capital just naturally draining right out of stocks.
So, what does this all mean for us? Section 5, how this affects you.
Okay, let's take a breath and look at some history. We have survived yield spikes before. Back during the 1994 Great Bond Disaster, 30-year yields spiked from under 6% to over 8% in just months, totally blindsiding everyone. Then, during the 2023 banking crisis, the 10-year Treasury briefly clipped 5% and sent bank stocks into a tailspin. In both of those cases, rates did eventually stabilize. But the real fear right now? It's not just a temporary spike. The big worry is that 5% might actually be our new permanent floor.
So practically speaking, what do you do with your cash in a market like this? Well, if you're just looking to safely park some money for a down payment, or maybe you're retired and need stability, short-term treasuries, like the 3 to 12-month ones, are offering a fantastic, really flexible 5% return right now. They're great for preserving capital, but you've really got to watch out for the long-term stuff. Locking into 10 or 30-year bonds means you are taking on a lot of volatility. Remember that inverse relationship? If yields keep climbing, those long-term bonds could actually lose a huge chunk of their value in the short term.
And look, as incredibly tempting as a 5% risk-free return sounds, we can't forget the golden rule of investing here. Treasuries are designed to preserve the capital you already have. Stocks are historically how you actually maximize and grow your wealth. Over a 10 to 20-year timeline, a safe 5% bond yield is very likely going to be completely eaten away by inflation and government money printing. So if you pull all your cash out of stocks today just to chase that 5% yield, sure, you might feel protected right now, but you're doing it at the massive expense of your long-term growth.
There's a quote from our source material that I think hits the nail right on the head. It says, "This is a sign that the free money era is really coming to a bit of an end. Everything has to readjust to a market where interest rates are staying high for longer." I think that's the crucial takeaway. The bond market breaking doesn't mean we're facing some apocalyptic crash tomorrow that's going to wipe out the economy. Instead, we're witnessing a slow, methodical tightening of the entire financial system. We are finally waking up from a 15-year fantasy land and having to readjust to a real world where interest rates stay higher for a lot longer. Which brings us to our final thought for today. The bond market is flashing a crystal clear message. The era of cheap, free money is effectively over. The absolute best defense you have right now is to stay flexible. Don't take on too much debt. Definitely don't assume interest rates are going to magically plummet back to zero tomorrow. And whatever you do, don't panic sell your long-term investments. So I'll leave you with this. If 5% really is the new floor rather than just a ceiling, how will your portfolio survive the end of the free money era? Thanks for joining me for this explainer.